India relies heavily on oil. Last year, we imported a whopping $137 billion on oil. Israel and Iran are on a collision course. This could have an impact on reducing India's GDP by about 0.3%. What if your grocery bill doubles tomorrow? Your fuel prices skyrocket, or your EMI payments go through the roof? Well, all of this could be happening because of a conflict thousands of kilometers away. Here's the thing, India relies heavily on oil. That's about 85% of it is imported. And just last year, we imported a whopping $137 billion on oil. That makes it nearly 15% of our entire import bill. Now, that's a big chunk of the economy that depends on something that's incredibly volatile. Right now, Israel and Iran are on a collision course that could ultimately push oil prices through the roof.
Israel has carried out
multiple airstrikes on Iran.
Israel is striking Iran.
Satellite images
show damage at an Iranian Revolutionary Guard base.
Tonight, Iran has launched a barrage of missiles towards Israel.
In today's video, we're going to cover 6 things. The first thing we're going to cover is why are oil prices rising? Second thing we'll cover is what is the current situation in Israel and Iran on the ground and how that's impacting oil reserves. We'll also look at what is the best to worst case scenarios and what would happen in those scenarios for different asset classes. We will start looking at what's happening in the Indian economy and the impact that we can expect due to these oil price changes. And we'll also look at specific sectors and maybe some stocks that could do well or could lose out in the current oil price volatility. Finally, we'll also have a bonus section where we look at the indicators that you should be tracking for the upcoming week and that could have an impact from the ongoing Iran-Israel conflicts. So let's get into it. When Israel launched intense airstrikes on Iranian targets over the last few weeks, oil prices jumped nearly 7% overnight. The crude oil, which is the global benchmark, surged past $74 per barrel, as you can see on this chart, and is currently hovering roughly around $76 per barrel. And all of this has happened because investors are panicked. Why are they panicked? Well, because one of the world's most crucial shipping routes, which is the Strait of Hormuz, which sits just between Iran and Oman. This accounts for nearly 20% of global oil that passes through this channel almost every day. In terms of number of barrels, that's around 18 to 19 million barrels. And if this route is disrupted, that could have a significant impact on the global energy market, where the prices for oil could potentially explode even above $100 per barrel. Now, for you as an investor, why does that matter? Well, think of if prices, the fuel prices that you're paying today, go beyond 150 rupees or 200 rupees per liter. That's nearly doubling of your current outflow. Your monthly grocery bill would also explode. You would have your potentially, any of the transporting goods that we are sort of intaking the benefits of, all of those prices get more and more heavier. And something even as simple as your EMIs, your home loans, any credit that you're paying could also see a potential rise because of inflation-driven interest rate hikes that we could see. So what's really happening on the ground? Well, Israel's recent strikes have significantly damaged Iranian energy infrastructure. The giant South Pass gas field, which is responsible for nearly 80% of Iran's overall gas output, has faced potential shutdowns. This is obviously not a minor inconvenience. This is a significant hit to Iran's oil output capacity. And ultimately what you can imagine is, cutting off power supply to an entire city. That's the level of disruption that we're talking about here. Meanwhile, when you look at Iran's exports, those have also fallen. They're nearly halted almost completely, as you can see in the chart. Satellite images are showing that there are no tankers that are leaving Iran's key oil export hub, the Karg Island. This is a lifeline of Iran's economy, which is choking. And when that desperation kicks in, this conflict has the potential of escalating further. Iran has also been shooting weapons and attacking the Israeli sites. And what we can see is that there are 2 of their major gas fields have also been shut, forcing them to rely heavily on coal and oil. This has also had obviously an impact on the local economies of Egypt and Jordan, where we are seeing major industries like fertilizers, which are coming to almost a complete stall. And ultimately, this could be a significant chaos, at least for the Middle East region that we're looking at right now. So how could this get better or worse? Well, there are 3 scenarios that we can think of right now. The first case is the best case, de-escalation, containment, the conflict resolves very quickly. In this scenario, diplomatic efforts result in quick diffusion of these tensions. There might be potential military or retaliatory acts by Iran and Israel, but all of this remains contained, limited to those 2 countries, potentially symbolic in nature, less significant infrastructure damage or civilian harm is there. And these sort of diplomatic talks may potentially reignite border security talks and sort of the wider Middle East region's conflict goes down. Here we can look at, let's say, the oil prices. Potentially there will be a short-term spike in oil prices, but we could normalize back to pre-crisis levels. Inflation would obviously be there again for a brief moment in time, but again we'll expect it to normalize, and your wallet ultimately breathes easy. Supply chains would be disrupted, but again it'll be minor disruptions without any major lasting effects. And from an investment perspective, there is quick recovery in investor confidence, rebound in risk of assets, and ultimately the reversal of any safe haven asset flows into gold or bonds that we would have seen in the last few weeks. Ultimately, from an overall perspective, it feels like we've come to a very close call, but your life goes on. The second scenario here is the medium case. This is where the tensions prolong. There is a proxy conflicts. Neighboring countries potentially get into the conflict as well. The tensions continue without any direct large scale increase in the conflict. Potentially Syria, Iraq, Yemen, Lebanon, maybe via Hezbollah or any of the local groups could also enter the war or the conflict. But these are limited to very specific, isolated confrontations, strikes, cyber attacks, etc. So in this scenario, when we look at, let's say, oil prices, there would be an increase in oil prices. There would be more volatility due to the impact in that Middle East region and the sort of uncertainty that's there. When we talk about inflation, again, due to this proxy conflicts, oil prices would stay high. Life over time becomes gradually more and more expensive. Supply chains again become more expensive due to logistical costs increasing. There could be heightened increase in shipping insurance premiums, moderate disruptions in supply chains, and all of that could have a knock-on effect on what you are ordering today as well. From an investment perspective, there is increased risk aversion, potentially volatility in the equity markets, higher demand for safe haven assets like gold, US dollar, bonds, etc., and maybe even reduced foreign investment for many emerging economies. Here you might be start thinking about, not taking, those sort of weekend drives, reducing your unnecessary expenses, maybe some of those vacations start dropping down your list. The third scenario is probably the worst case scenario. It becomes a regional war where the Strait of Hormuz also closes up, and this could involve increased participation from major economies such as the US, China, Russia, UK, etc. as well, and ultimately has a massive impact in the overall global energy flows. From an oil perspective, we could see prices rising quickly beyond $100 and even $200 per barrel, and this would ultimately depend on how long this conflict sort of persists. From an inflation perspective, everything becomes expensive very quickly, and it's quite significant. So your groceries, fuel, loans, anything that has an impact from an energy market perspective becomes more expensive. And like we discussed earlier, supply chains could face major disruptions. It could have a significant impact on global trade as well. There could be widespread shortages, and manufacturing processes could be halted as well. From an investment perspective, you're looking at extreme volatility, sharp market declines, systems from a financial perspective could become quite unstable, and the global economies could potentially fall into recession or a depressionary period as well. For India, this third case scenario naturally as an emerging economy is quite catastrophic, and here's why it's catastrophic. India already imports 85% of its oil. For every $10 increase in crude oil prices, this could have an impact on reducing India's GDP by about 0.3% and increase the inflation that we're seeing by about 0.4%. Now that's real money that is going to ultimately come out of all of our pockets. And if we think about shipping, this could escalate, the shipping insurance that we spoke about earlier, which could jump by about 15 to 20%. This makes exports that India is doing for other countries less competitive. Businesses that have been exporting, let's say, pharmaceutical goods, textiles, precious metals like diamonds, all of this would take a hit. Even companies that have operations in the Middle East region, specifically in Israel, let's say like TCS, Infosys, pharma companies like Sun Pharma, etc., could also face serious disruptions. They either have to shut down their operations completely or temporarily, which ultimately would have an impact on the profitability metrics and the growth that they would have seen in this year. So for Indian companies, the net is that the cost of business would go up depending on what scenario we're looking at. But specifically, what sectors could do well and what could lose out in this scenario? Let's look at that right now. So who loses? Firstly, airlines. It's very obvious. Post the accident as well, we've seen some sort of shock in the airline industry. Rising fuel prices could have a further impact, which would potentially make not just tickets more expensive, but airline travelers could also reduce, and that could have an impact on hurting companies like Indigo, which typically spend nearly a third of their revenue on fuel. The second industry that we'll look at is FMCG and retail. Here, transportation costs might rise, which will ultimately have an impact on the profitability, their margins, and could also potentially lead to an increase in the price of products. Companies like HUL, Nestle, ITC, all of this could be impacted as well. The third industry is automobiles. Here, you could see the rise in fuel costs could lead to a lower demand for cars. This would obviously have an impact on the sales that these companies such as Tata Motors, Maruti Suzuki, Mahindra were doing, but we could on the counter side see a potential benefit for electric vehicles who could gain an edge out of this scenario. Paint companies like Asian Paints, Berger, Nerolac could depend heavily on oil-based raw materials, and the rise in oil prices could shrink their margins as well. Chemicals and petrochemicals, we did a video on this earlier as well. Higher crude oil prices could increase input costs for companies like Pidilite, SRF, Aarti Industries, Deepak Nitrite, etc. as well. And similarly, we look at, let's say, fertilizers that also relies heavily on natural gas, crude oil, and an increase in the sort of raw material for these companies, even though they get government subsidies, could have an impact on farmer expenses as well. From a winning scenario, there are three potential sectors that you can look at. The first one is the oil refiners, the oil marketing companies like BPCL, Reliance, HPCL, IOCL. All of these could see higher profits from the volatile oil prices that from an increase in the price that's happening. And if that isn't passed to the consumers, then there could be significant impact on their bottom line as well. From a defense perspective, post Operation Sindoor and the India-Pakistan conflict, there is already rising spending on defense, but increase in global tensions could lead to an increase in further boost of defense spending, which could have a benefit for Bharat Electronics, HAL, Bharat Dynamics, etc. as well, along with any other drone companies that are there. From a gold and finance perspective, we would naturally see investors driving towards safer assets during these uncertain times, and that could have a benefit on gold companies like Titan, Muthoot Finance, etc. So if you're worried, here's what you should track closely. First, Brent crude prices. Anything over $80 is quite risky. It indicates higher inflation, more instability, and this inflation risk could also push FIIs further away from investing in Indian equities. Second is the US dollar and the Indian rupee exchange rate. The Indian rupee was already hovering nearly at a 2-month low at around 86-87 rupees per dollar. As crude prices increase and there is more geopolitical risk, we could see this exchange rate sort of having an impact. RBI could intervene and stabilize the currency, which could also have an impact on bond yields, liquidity, etc. But ultimately, a weak rupee means import costs are going to rise dramatically, and that impacts your ability to potentially purchase things as well. Third point is RBI's monetary policy. A high oil price might indicate that the RBI may want to delay interest rate cuts, which could have an impact on your loans, EMIs, credit, investments, etc. Fourth is gold. Geopolitical uncertainty has lifted the 24-karat gold prices roughly above the 1 lakh rupee per 10 gram mark, and we've seen similar for silver as well, and that is coming out to nearly record levels right now. The last point that you should sort of consider is the domestic central bank and inflation data. This typically comes out towards the end of the month for global markets as well, and you could see significant macroeconomic data such as US durable goods, UK's inflation rate, local indicators of potential output for the first quarter of this financial year, the industrial output, etc. And all of these would have an impact in terms of guiding the RBI towards setting interest rate expectations amid the geopolitical risks. The Israel-Israel conflict directly will have an impact on your daily life, whether we look at it from a basic or the best case scenario to the worst case scenario. There is some sort of economic volatility that could be expected and will be inevitable if the tensions continue to escalate. The best way for you to handle this uncertainty is to stay informed, make sure your finances are in order, and be ready to be quite flexible. In this moment, being knowledgeable and understanding this environment is quite important. Drop us a comment below if you like the video. Do let us know what other topics you want us to cover. Do share, like, subscribe. That all really helps us with the understanding how these videos are doing. If you enjoyed today's video, do check out our last video as well, where we spoke about specifically on whether you should be investing in market crashes and how that could be beneficial or could not be. So thank you so much for watching today's video. Happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.